Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. Not a whole lot has changed since this time last week. Miles, the charts you had up last week have helped guide me the entire 7 days since our last recording, and I would point the listener to those charts that show last week. But what do you have to add here, either from a technical or underlying fundamental standpoint?
Sure. I think technically we're certainly seeing things play out that we discussed last week with increased upwards movement in the precious metals, as well as the equity markets seeming to top out. And then we had a longer discussion about Treasury yields, which are continuing to come down, especially today. We are recording Wednesday, just a few minutes following the FOMC meeting where we found out we will, Merry Christmas, be raising interest rates another 0.5 point before the end of the year.
Well, Miles tends to be Mr. Technical, and I lean more towards the fundamental side. So today it's kind of fun to have
switch places.
Yeah, that's right. We'll switch places, but have a show focused probably more on those underlying fundamentals. Obviously, that's a significant one. Gold in the minutes following that announcement did drop $10. We got to around the 1813 mark on gold, dropped down to right around 1800 actually, and it gained all of that back. Now as we record, we're right back to 1810. So minor volatility, but the more exciting thing, quite honestly to me, is the silver price exceeding the 24.
Right. I think gold understands what's happening. The currency markets are having a little bit harder time accepting it as we're simultaneously seeing the Treasury bills continue to decline significantly, as well as the dollar, which has broken. We talked about this yesterday in our office meeting, has continued to push down. So I might just get that little perfect head and shoulders play out here in the dollar index over the next couple weeks, month or two, which would certainly allow me to pat myself on the back. Not that I'm into divination or anything, but I'm allowed to get one right in a career. So maybe this will be the one. The Treasury yields, though, I think is worth pointing out because I was mentioning before we started recording, I'm listening to Powell speak and the questions come up, and it's just, when are we getting the punch bowl back over and over and over and over again using different words? And every time I hear the guy talk, I like him more and more because you can tell he's just ready to strangle some news people. He's just so sick of it. He's like, guys, we're not. We have to get inflation down to 2%. We have to get the Fed funds rate up. It's going to continue. There's for a quantity of foreseeable future that I don't have an answer to yet. And he keeps saying he's going to stay the course, and we'll see if he does. So yeah. I've been asking for 2 years, do we have Greenspan or do we have Volcker? And we may have Powell. We may get to say this is Powell, a whole new category.
Powell's in a tough spot, and he has to go out and be hawkish, right? Because the more surprising news of the week, honestly, was the CPI number coming in. So 7.3% expected on that core inflation number. 7.1 is actually what came in.
Right.
So because it was better than expected, the equities markets rally, and everybody's thinking happy days are here again, because that means that clearly we're having success, and Chairman Powell may not release news on Wednesday that they're going to raise the rates 0.5 point. Well, everybody knew that was a foregone conclusion. He had to come out today and control and temper the markets, because two key takeaways for me. He said the time is approaching to begin slowing down these hikes, right? Just slowing it down.
Right.
Right. Maybe that means that you have just a couple in 2023. But what he was also very clear about, as he was telling them they weren't getting their punch bowl back, is that there will not be any cuts in 2023.
Right.
They're not going the other direction. So when you're asking for the punch bowl, I'm assuming you're talking about three things in jest. One is, when will the interest rates stop in terms of the hikes? Two, when will interest rates actually start to be able to be lowered again? And then three, when will the Federal Reserve really start quantitative easing again?
Right.
When everything's good and inflation's not a concern. That's the big punch bowl.
Yeah, and I love when he gets asked those three questions back to back to back, and you just see his soul break after each one. Yeah, I'm glad you brought that up, and you brought up the idea of the velocity and speed at which the interest rates are rising, because he actually brought that point up today, because he was asked what size hikes are we looking at going forward, and he brought up the idea that this is becoming less about the size of the hike and more about the duration that we have to keep the interest rates at higher levels. So not only did he address one of those points, he actually addressed two of them, right? He said not only are interest rates going to continue to move up, even if they slow down, the duration is going to be a lot longer than you think it is. So are we going to get back into the quantitative easing side of things? It sounds like he's hinting at no. So you're going to have to see government spending come down. You're going to have to see inflation rates come down. We're going to have to see something move possibly towards positive real rates. So with the inflation rate now down to 7.1, which is better than expected, and the Fed lending rate up to 4 to 4.5, 4.25 to 4.5, we still have a little bit of wiggle room in the real rate, still down a couple percent negative there. So there's still a lot of work to be done. Now, what fascinates me is the market is just having a really hard time accepting it. You know, like you mentioned, the Dow has done exceptionally well. I think the markets are up like 6% since November, but it does look to be topping out when you look at the charts. And your Treasury yields are starting to go down with interest rates going up. So the market just doesn't want to play. In fact, I looked right before I came in here. The 2-year Treasury yield is at about 4.2, and it's come down. And the 30-year is at 3.5. Why would anybody buy a 30-year at this point? Why not just buy a 2-year and see what happens? I believe Powell.
It's better than sitting in cash, but barely.
Barely. Yeah. So you're making 3, and that's kind of the offset of the real rate, right? The difference between 7.1 inflation and the 4.25 Fed lending rate. So you are netting positive barely. That's your real rate.
No, I mean,
difference.
that's for people with no liquidity concerns and just way too much money. So what else are they going to do with it? You know,
I got an idea.
There you go.
Look at what precious metals have also done in that same period of time.
Making you immune to it, and that's exactly what's happened. And here, towards the end of the year, I still am holding out hope. All I want for Christmas is a retracement in the gold price. I want it to come down before the end of the year. If it doesn't happen, fine, but anytime we get a discount, I'll take it. If we end up seeing the dollar get a little bit of a rally here per your perfect chart, gold should come down just a little bit into the end of the year. Maybe it happens right after the first of the year, but that likely will still happen. And so I'm holding out hope for that, and I don't know to what extent yet, but premiums decrease in a rising market. And we've talked about this for months on the show as silver hit these incredibly high premiums, and you had this incredibly high gold to silver ratio in the mid 90s. That gold to silver ratio now has come down to 76 to 1, and the premiums have cut in half in terms of some of the silver products,
right?
Which is why we were swapping out of it when we did to try to ring the bell, which we have done. The more the spot price climbs, the more you can expect premiums to shrink. So as the dollar would rally, gold would naturally turn down. If the dollar continues its weakness, gold will just, in my opinion, stay on this course of action. And that's where the underlying fundamentals come in. And that's barring some new legislation. You know, you talked about government spending. There's still a lot of opportunity to go further in debt and get some legislation passed before the Republicans take control of the House, and they're going to become sort of a lame duck type of a situation. They've got another 4 weeks here to really spend and get things passed.
And like you said about potential pullbacks in the precious metals side, just be aware, not only are we talking about entry opportunities and looking at how ratio trades play and how the metals move with and against each other. Also, from my perspective, the reason why we like to look for these pullbacks in the precious metals side, and when they do it from a logical charting standpoint, is because it's not so much about gold, say, emotionally reacting to panic or fear or concern or even greed. What we're looking for is for gold to do what we expect it to do, and that's to build a steady, healthy growth model over an extended period of time. And you need these pullbacks to kind of take your foot off the gas a little bit, let things kind of build a little bit of momentum back underneath them, and then get ready to take that next step forward. And you know, when we get into January or February, I hate to say it, but that historically is when we see gold take those nice big steps forward.
That's going to do it for this week's Golden Rule Radio. If you like what you heard, ring the bell, subscribe, and you can also follow us on Twitter at ICA Gold, and also our website, McIlvaney.com. You can find us on Facebook at McIlvaney Financial. As always, give us a call. It's far better to speak about your individual portfolio with an advisor here at McIlvaney Precious Metals. That number is 800-525-9556.
Thanks for listening and have a great week.